Rathbones Group fell 17% on Tuesday after disclosing that an FCA skilled person review had found consumer duty failings in its UK wealth management arm. The firm is blocking new high-risk client onboarding for up to 12 months and pausing inflows from 4,700 existing clients. The bottleneck is not the £60 million remediation charge. It is the question of whether that freeze translates into permanent AUM attrition, and the buyback is what makes the answer genuinely unresolvable. On the same morning Rathbones published the review findings, it confirmed a £20 million share buyback, recently approved by the Prudential Regulation Authority. The two announcements are in direct tension. A buyback signals that management believes the share price is below fair value, which requires believing the AUM freeze is temporary and the remediation cost is bounded. The market sent shares to a one-year low, pricing in the opposite. The FCA's skilled person review is not a formal enforcement action. It is the regulator commissioning an independent expert to examine a firm's activities before deciding whether to escalate. That distinction matters. Rathbones disclosed this voluntarily and described the FCA engagement as constructive. CEO Jonathan Sorrell called the remediation work a path to becoming the best wealth manager in the UK by far, framing a compliance failure as an acceleration of the existing strategy. The question the buyback forces is whether that framing is grounded or whether management is optimizing for short-term price support during a longer-duration structural problem. The £. That is the annual gross inflow volume from the 4,700 EDD clients, now frozen out of new investment activity for up to 12 months. If those clients begin withdrawing rather than simply waiting, the freeze becomes permanent attrition, and the buyback math collapses. The hidden assumption in the management read is that EDD clients, politically exposed persons, high-net-worth individuals from higher-risk jurisdictions, will hold their positions while Rathbones conducts its 2-year remediation. That assumption is precisely what the market is refusing to grant.
The £530 million frozen inflow figure has a second layer that the surface coverage underweights. Separately, Rathbones disclosed a further £370 million in new EDD client inflows it will no longer accept for 12 months. Combined, that is £900 million of gross annual inflow capacity taken offline, against underlying pre-tax profit of £238 million in 2025. On top of that, Rathbones is removing investment management fees on cash balances in discretionary portfolios from July 1st, a move it estimates will reduce underlying pre-tax profit by £9 million in 2026 alone. The £60 million remediation cost is recognized as a non-underlying expense over 2 years and excluded from headline profit, but the £9 million fee cut is not excluded. It hits the underlying number directly. This is the reversal the consensus is missing. The market is selling Rathbones on the £60 million headline charge, which is an exceptional item. The more durable drag is the £9 million per year structural pricing change and whatever AUM attrition the freeze produces. The FCA's consumer duty framework came into force in 2023, and the regulator has explicitly signaled it will intensify scrutiny of wealth managers' governance, pricing structures, and client outcome monitoring. Rathbones' case is not isolated. It is the first large-cap UK wealth manager to disclose a skilled person review outcome under the post-2023 consumer duty regime. If the FCA pursues similar reviews at peers, St. James's Place, Evelyn Partners, Brooks Macdonald, the sector repricing is systemic, not company-specific, and Rathbones' 18% drop is the first data point in a wider discount. The counter-evidence management is leaning on. The dividend policy is unchanged, the buyback is proceeding, and the review does not allege client harm. It flags implementation and embedding weaknesses. If those weaknesses are genuinely procedural rather than outcome-producing, the 2-year remediation is a cost event, not an existential one, and the 18% sell-off is excessive. But the FCA has not closed the review. It has only initiated the remediation. The gap between areas for improvement and a formal enforcement referral remains open. For holders, the decision variable is whether the firm's next quarterly update confirms EDD client retention, specifically whether the 4,700 frozen clients are holding assets or initiating exits. For watchlist candidates, the entry case requires seeing that first quarterly AUM update and confirming the consumer duty wave is not repricing peers, which would remove the mean reversion argument. The monitoring variable is EDD client AUM in the second half trading statement. That number decides whether the buyback was a well-timed confidence signal or a misread of the attrition risk. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.